Hello and welcome to Mint Funds Update. My name is Marek Krzeczkowski and I'm joined by Ryan Falls. Today we will talk about our market outlook and what happened within diversified funds last month. We obviously have to start with US election. That was by far the biggest event over the last month. Before the election, so-called Republican sweep, a scenario where Republicans take US Senate, House, and presidency, was estimated to be around 15 to 25%, depending on the source. But as we look at the results just now, it looks like Republicans will actually win the US House. So that scenario looks very likely. Now, the implications for the markets are interesting because when you compare both plans from Harris and Trump campaign, what you'll see is that Trump is estimated to spend a lot more. So the fiscal impact is estimated to increase deficit by around $8 trillion. And despite that, markets had a very strong positive reaction following the election. Now, the main reason for it is that Trump's plan is the opposite to what Harris was proposing in many ways. But markets particularly like the tax cuts. So you see that the majority of the deficit, of the increased deficit, is actually tax. It's corporate tax, personal income tax, quite a lot of cuts. And this was opposite to Harris, who was actually looking to increase corporate tax as one of the examples. Now, looking at the detail, things like reducing corporate tax from 21 to 20%, but more importantly, in the line with Trump's Make America Great Again, a 15% corporate tax for companies that manufacture goods in the US. Tax cuts for individuals, tax incentives for oil and gas drilling. That obviously is a big thing because markets look at that as lower energy prices and perhaps making US products more competitive, allowing more growth as the costs of production are lower. Also a lot of regulations, so cutting regulations across the board, anywhere from consumer finance, financial protections to bank regulations. Obviously, there are things that are a big question marks as we speak today. Two which are worth mentioning today. So deportation of undocumented migrants and strict immigration rules. So obviously Trump is talking about the biggest deportation program in the history. That could have that's a big unknown. We don't know how that will impact job market in the US, especially if we're talking about bringing manufacturing back to US, and in the meantime deporting a couple million people. And also one thing which a lot of people talked about a long time ago, tariffs. So Trump was talking about, during the election, he was talking about 60% tariff on goods from China and 10 to 20% tariffs on other goods. So obviously these remains to be seen. We don't know whether that was just part of his rhetoric. And this is something we will be watching very closely. Moving forward, we are still looking at the soft landing scenario next year. We see a very strong data in terms of growth. Inflation is actually moving down to central bank's target range. We also see low unemployment, particularly in the US. So this is obviously in the global context. So we would expect next year central banks cut rates, support the growth. And we believe, as we have been for the last couple of months, that the soft landing is more likely than it was, this time last year.
Thanks for that, Marek. I'll take you through the diversified funds performance for the previous month, and we'll start off here with the Mint Diversified Income Fund. So the performance for the month was actually flat at 0%. We had global equities contributing -0.1%, Australasian equities contributing +0.3%, and in fixed income, small detractor, -0.1%. So as I mentioned, asset class performance was broadly mixed in October. This is on the back of global markets fretting over the results of the upcoming US election. And then domestically here in New Zealand, RBNZ relaxed interest rates further. And turning to the positive contributors for the fund, within global equity, we had Martin Marietta Materials Incorporated up 10.1% and Charles Schwab up 9.3%. And they were our top two contributors for the month. For Martin Marietta Materials, markets reacted positively to their Q3 earnings report, where they shared strong guidance for the building materials market in 2025. Within Australasian equities, Circle was up 17.9% and Skellerup was up 11.3%, and they're the two standout names. Circle bounced at the end of October after announcing a strategic tie-up with Sabre and purchasing their online corporate travel to get there. Within fixed income, we've seen the curve steepening led down by the front end of the curve after RBNZ cut 50 basis points at their October meeting. Where Precinct Property 2027 bond was our standout performer. It benefited both from compression in those short end yields, but also then in the credit spread for the issuer. Turning to the negative side of the portfolio, within global equities, L'Oreal was down 14.4% and LVMH was down 11.4%. They were both detractors from performance. Both companies actually suffered due to continuing concerns on the economic trajectory for China. And their largest drop during the month actually occurred when their rival Coty announced weaker demand, particularly in the US during their Q2 earnings report. Within Australasian equities, we had NextDC was down 6.2%. This actually lost some ground as an equity research analyst that said he speculated that it would need to raise additional equity capital sooner than expected if NextDC accelerated their expansionary plans in Asia. Turning now to the growth fund, so performance for the month was negative 0.5%. This was led by global equities down negative 0.7%. Australasian equities was up 0.4% and fixed income was down negative 0.1%. So as I mentioned, asset class performance mixed in October. Globally, as I mentioned, markets were fretting over that US election. Within global equities, Martin Marietta Materials was up 10.1% and Charles Schwab was up 9.3%. So again, top two contributors for October. Charles Schwab this time they bumped after reporting Q3 earnings with revenue and earnings both beating analyst estimates. Turning to Australasian equities, Circle again and Skellerup again were the two standout names. Circle actually bounced at the end of October again after announcing that strategic tie-up with Sabre and their corporate travel to get there. Within fixed income, we've seen curve steepening, again led down by the front end of the curve. As Oceania Healthcare was actually our standout performer in the growth fund, so it benefited from that compression and short end yields. Looking at the negative contributions for the fund within global equities, Thermo Fisher Scientific was down 11.7% and L'Oreal was down 14.4%, and they were the main two detractors. Thermo Fisher Scientific slid after announcing their Q3 earnings, in which their net income declined quarter on quarter. And then turning to Australasian equities, we had NextDC down 6.2% again. It went down the most after equity research analysts speculated would need to raise that additional equity capital for their Asian expansionary plans.
All right, thank you for listening. If you have any questions, please send them to info@mintasset.co.nz.